My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends, just trying to make you some money. My job is not just to entertain, but to educate and teach you, so call me, 1-800-743-CNBC, or tweet me at Jim Cramer. We're in the eye of the storm. Only when we got down almost 20% from our highs did we realize that the storm just wasn't that violent. We're dealing with a normal cyclical downturn and not serious systemic devastation. And that's how the Dow rallied 466 points today. S&P surged 2.39%, and the NASDAQ came all the way back, going up 3.82%. Still a tough week, but a nice finish. Now, I think we've simply been overrun by bad events here, which make habitual dip buyers too terrified to take action on the way down. The parade of horribles is committed to memory by now. Ukraine, inflation, Fed's response to inflation, China lockdown. So when you add a fourth, the Bitcoin crash, well, it all becomes too much, and the market falls apart, and people worried about the center not holding. Then a funny thing happens when stocks go down, though. The risk goes down, too, which is one reason the market so often tends to find a floor down 20% from its highs, which it did again. When we've been beaten down to these levels, we reach a point where stocks that would normally be clubbed have already taken enough hits. And that alone has allowed them to have at least a short covering rebound, which is what today might have been. Which brings me, of course, to my game plan for next week. On Monday, we have a lot of classic cases this week of exactly what happened today. On Monday, Take-Two Interactive reports, and this video game company is down more than 100 points from its all-time highs. But has anything actually changed here? Yes. The games have gotten better. And even though the world's going back to normal, people are still playing them. Admittedly, if the stock were still at $200, it would be a disaster waiting to happen. I know that, but down 110, I'm telling you, it is okay. Next, you tell me what the weather will be, and I will tell you how much I want to own shares in Home Depot when it reports Tuesday. This is a great retailer. It caters to every homeowner's needs, but most importantly, it caters to the spring and summer season for everything from grills, which have not been doing that well, to just the tomato flats. Good weather this weekend, and I bet this stock will erupt. Now, I'm not as certain, by the way, about Walmart. That's a name owned by my charitable trust, simply because it's been bouncing around way too much. But the stock's at the low end of its recent range. It traded at 159 not that long ago, so it might be good for a trade. Now, by the way, we are always wanting to test the market's appetite for companies that recently came public. And next week, we've got 3 of them. I mentioned Weber for grills. That will be on sale. Maybe have a big weekend at Home Depot. Warby Parker, which has lost people a lot of money. And then Doximity, another one that has lost people a lot of money. It's an online network for doctors. All the new stocks have been disasters, people. And I know that. And it's one of the reasons why I've been so concerned about the market. There's too much money being lost. Let's find out how forgiving this market's willing to be when it comes to these recently, the relatively recent IPOs. And I'm betting maybe by the time we get to here, they'll be unforgiving again. But you can get a bounce in these. Hey, look out. James Bullard from the Fed speaks out Tuesday, and he's a hawk's hawk. He's also my kind of hawk. Bullard knows it's only going to get harder to break the cycle of inflation if the Fed doesn't act decisively right now. He'll have a lot to work with because retail sales come on Tuesday morning, and I expect them to be very strong, too, because the consumer's so strong. Too strong as far as the Fed's concerned, and I'm still upset that Jay Powell, whom you know I think is a great Fed chief, took that 75 basis points off the table. Wednesday's the day of fireworks. As Target has to do better, this is unfortunate the way the calendar works, Target has to do better than Walmart, okay, and Lowe's has to do better than Home Depot. That's the comparisons, and if they don't, the stocks get hit. Now, at least that's the conventional wisdom. You know what? This time around, I disagree because of how bad the market's been. It's so beat up that all of them might work here. I see these retail stocks as barometers of the consumer. These are all companies that either help homeowners and people who are still buying homes for now, even with a spike in mortgage rates, which makes sense given the fact that even though there's going to be a slowdown, it's just a better deal than renting because the rents have gone up too much. Good or bad, we'll figure out which aisles have goods that are selling well, tools, paints, and then we can come back with a battle plan. Next up, people have really turned against TJX, the parent of TJ Maxx and Marshalls, because they think that it has a merchandise problem. These guys typically buy excess inventory from regular retailers at bargain basement prices. But what if nobody's got excess inventory? What if there's no glut? There was a problem like that, but since Christmas, so much seasonal merchandise got stuck on boats and ended up coming in late that the stuff now has a home. TJX. I'm predicting a good quarter, although the stock often starts off soft when they report the news, and the rallies come in later in the day. So be prepared. The people who act fast are usually wrong. Now, the silence out of Cisco, the networking kingpin, I find has been deafening. As a shareholder for my charitable trust, which of course you can follow along by joining the CNBC Investing Club, I am actually beginning to wonder if the hope for upside surprise from all those orders that were nodded happens, or if they're frayed knots related to Europe. That's a big market for Cisco. In order for this one to work, the company needs to speed up its shift from hardware to software, or else the stock is going to get clobbered, probably gets protection from some of its dividend, maybe to 3.5 level. Again, I'm not that bullish on it because I'm just not hearing the kind of pin action I like. Thursday morning, we hear from an outfit. Oh, boy, I got to tell you, this place is this on the fire line. It's called Kohl's. The drama seems to be winding down with this one in terms of a challenge to the board. But how about an actual offer from one of these private equity firms that keeps saying they want to put money to work? I doubt Kohl's has any desire to sell. The board's quite entrenched. But at the right price, of course, anything's possible. I think this could be a 3 down, 10 up situation because the stock's fallen so far from its highs. I like those odds. You know what could be the single best story of the week? Palo Alto Networks on Thursday night. This is the best-of-breed operator in the cybersecurity space, and that business isn't going away, even as the stock has come down with everything else in tech. I bet we'll be pleasantly surprised. I like what CyberArk had to say. Obviously, the bad guys are taking no vacation. Now, one of the worst areas in this whole market has been the semiconductor capital equipment space, which is so counterintuitive. It's astounding. Now, we know from speaking to Tom Caulfield, the CEO of chip manufacturer Global Foundries, that demand is soaring. He's sold out for 2 years. So why shouldn't the semiconductor equipment place be soaring too? Now, one of the reasons why is that Lam Research, a big competitor, trimmed its estimates last time, and that could happen to Applied Materials. But remember, Lam's problem was a shortage of materials, not a hit to orders. We keep hearing that as a theme for this quarter. Applied Materials could change the cadence. Now, just as I like TJX here, I'm also looking forward to Ross Stores on Thursday night, one that I haven't in a long time. They're in a similar business. Wall Street's not giving these off-price plays enough credit because there hadn't been enough off-price merchandise. The apparel name everyone hates is VF Corp, and with so many other stocks down, you know what? I'm going to tell you, I don't want to get there. You can go do it, not me. Now, there's another one that's the same way. People are always drawn to Foot Locker. They think it's cheap, cheap, cheap. I'm not one of those. I like quality growth. You like Foot Locker, just please go buy Nike. However, I do like Deere, which also reports Friday. I like it because 13% of all the calories in the world are being destroyed by the pointless, inane, and criminal war that Russia's waging against Ukraine. Famine's beginning to break out around the globe. The price of all grains is through the stratosphere, and that means Deere's year could be very good. But this is another stock that tends to react very poorly to the headlines and then rebound at the end of the conference call. Patience is a virtue. Here's the bottom line. Many stocks have finally come down to the point where it's safe to be constructive, as long as you stay away from the most toxic areas. So I'm breathing a sigh of relief here. I want to go to Blake in Illinois, please. Blake.
Booyah, Jim.
Booyah, Blake.
Happy Friday from the Windy City.
Oh, hey, terrific. How have you been?
Doing great. So just wanted to pick your brain a little bit. I'm curious about your thoughts on Dollar General. Been a big fan of the stock since I visited a new store in Ohio, visiting some family. Surprised to see brand name items, fresh produce. Huge shift from how I remember the stores in the 90s as a kid. Fundamentals are solid as far as I can tell. The Q4 earnings resulted in a good bump, but it's been downhill ever since.
Blake, you are so right. Our viewers are so smart. There's been a share gain. They are doing much better. Dollar General, by the way, I like a lot more. Unfortunately, I like Dollar Tree to visit more than Dollar General. My Dollar General is not that great. But I think you're right. In a trade-down business, which hasn't happened yet, but a lot of people anticipate, that will be a very good window. We need to go to Bob in New York. Bob.
Hey, Jim, just wanted to say thank you to your staff. And Nicole is so darn polite. They're just great, and I wanted to let you know that.
She sure is. And I'm glad you pointed that out because people don't get enough credit around here for making me look good, most certainly. How can I help?
Jim, a couple of weeks ago, you mentioned that you added to your Microsoft position for the trust.
True.
And some things are confusing about what you're saying. And then a couple of weeks later, a week and a half later, you said it was too expensive. So we were a bit confused by that. And then on the morning show, when you mentioned Apple, you kind of equivocated on it by saying at the very last moment, you'll be okay with Apple. But it didn't sound like there was any conviction with either Microsoft or Apple. Am I misunderstanding that?
No. I mean, what I was trying to do was trying to be able to sell stocks and then buy them back after they come back to different levels. So what I was really focused on was the actual level. I wanted Apple to go down 20% before I felt it made the right price. I wanted Microsoft to fall 50 points. So what I was really doing was relative work about how far it had come down, not itself making a judgment about the stocks. I promise you, I will be clearer in these alerts that I send out for the investing club because of what you said. I did not get that right. I apologize. I was not clear in my thinking. It was a tough week. I won't let it happen again, or I certainly won't try. Let's go to Rachel in Florida, please. Rachel.
Hi, Jim. Thanks so much. I'm a longtime listener, but first-time caller and a 31-year-old member of your investment club.
Thank you.
I had so many stocks that I wanted to ask you about today, but I only could choose one. I'm up about 5-6%. Is Lululemon a hold, buy, or sell?
Okay, I think Lulu had a remarkable investing day, really one of the better. You can go through the whole deck. I think that this decline represents an opportunity for Lulu. I know there's more risk to owning Lulu than a lot of other stocks because it does sell at a high-priced earnings multiple. But they are executing at a level that no other apparel company is executing, and they have an ethos and a culture that makes it so I think it's worth a premium multiple. And by the way, Rachel and, of course, Bob, thank you so much for joining the Investing Club. The other day I talked over someone who was very gracious about it. That was a mistake. We're working hard on the club each week. I did a special video just tonight. I'm not going to rest until everyone is a member because I have done this for 16 years, and I think I know what the heck I'm doing. But, of course, I didn't do it all here, but now I do it. Many stocks have finally come down to the point where I think it's safe to be constructive. I'm breathing a sigh of relief heading into the weekend because I don't think that stablecoin is going to bring us down anymore. Well, Mad Money tonight. Hostess looked sweet this week on the Wall Street Fashion Show, didn't it? So is it time to take a bite of the company, find the infamous Twinkies, which I thought was going to close at one time? I'm checking in with a very motivated CEO. Then from sweet to salty, I'm taking a closer look at UTZ, that's UTZ kind, after today's post-earnings move higher with the chip maker's top brass. And Zebra Technology, stock's been cut in half. It's so good, they're buying back stock aggressively. I'm learning more about how the sector is faring with the company's CEO. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.